Hi there, in this video we want to take a quick look at the key limitations of ratio analysis. Now you'll remember that ratio analysis involves getting hold of financial data, in particular from the income statement and the balance sheet of a business, and using that, calculating ratios, interpreting the data, and the aim of which is to gain insights into how the business is performing. So it's a very common, very popular way of producing analysis on business performance. And of course there are several different types of ratios. Let's just quickly remind ourselves of what they are. The profitability ratios, they're things like the gross profit margin, operating profit margin, and of course return on capital employed, looking at the return compared with how much capital is invested in the business. When we're looking at the ability of the business to pay its debts, to remain solvent, we're looking at key liquidity ratios, in particular the current ratio, and if it's on your specification, the asset test ratio as well. And also when we look at how efficiently the business is managing its assets, we look at aspects such as payables days, receivables days, how quickly it's turning over its inventory, and also the gearing percentage, which looks at the relationship between debt and equity in the financial structure of a business. So there's a whole variety of ratios that can be calculated looking at profitability, liquidity and financial efficiency. But are they enough? What are the limitations of those ratios? Let's just quickly look at some of the key evaluation points there. I guess the first thing to say about ratios is that, of course, simply calculating a ratio using one piece of data is never enough. You need to look beyond just one ratio, one piece of data. Also, you can question how reliable the data is, in particular because it's based on past information or typically based on historical financial accounts. And also you need to have a think about whether the data you're looking at is comparable. Let's just briefly look at those in a bit more detail. Why might ratio data not be entirely reliable? Given that we know it's widely used, ratios are calculated by the investment community, by the financial press, they're very widely used. Well, one of the issues is that the information that ratios are based on is drawn from the financial accounts of a business. And of course, we know from looking at accounts that a lot of the judgments made in putting a set of accounts together are quite subjective. So one accountant's view on how to treat an item might be different from another. Businesses have different accounting policies, for example, in terms of how they recognize the valuation of their stocks or when they recognize profits on things. Now, of course, there are rules for trying to ensure that financial accounts are fairly consistent, comparing one business with another, but there's always some scope for judgment. And also there's scope for, let's call it manipulation of year-end figures, particularly when it comes to the balance sheet. It's a concept called window dressing, just making the balance sheet look slightly more advantageous than it really was. So you have to be careful about the reliability of the data, and also you need to make sure you compare relevantly. So it's not enough just to calculate one ratio for one business. Ideally what you would do is you compare that ratio with other relevant businesses, in particular competitors. That makes ratio analysis more useful. But also you need to look at the trend. Compare a ratio from one period to another, or even better, over several periods. That's going to make the ratio much more useful. You need to bear in mind, of course, that if you're looking at trend information, calculating ratios over time, that the circumstances may have changed that may have influenced those ratios. So we know from looking at markets that they change, aren't they? They're very dynamic. But also it could be the ratios are drawn from different periods when the economic and market conditions were different, which may have had an impact. So you need to take account of or be aware of the fact that circumstances may have been different based on the data you've calculated. And of course the other thing about ratios is that, as we've mentioned, they're largely drawn from the financial accounts, the income statement and the balance sheet. And that doesn't really tell you everything you need to know about the performance of a business. So a ratio doesn't necessarily tell you whether a business has got strong competitive strengths. There isn't a ratio that I know that says, or financial ratio that tells you how strong the brand strength is. I'm sure you might be able to pick that up from the operating margin or the net profit margin, but that's not the whole reason, is it? It doesn't tell you about brand strength. It doesn't tell you how well the business performs when it comes to things like quality, product quality or customer service. It doesn't tell you whether the business has a strong track record of ethical behaviour or dealing with its social responsibilities. It doesn't really tell you, because they're backwards looking, what the future looks like, unless of course you calculate some forecasts and then calculate the ratios based on those forecasts. So ratios, whilst they're useful, don't tell you everything about the overall competitive position and performance of a business. So overall then, when you look at the detailed ratios, how to calculate them, interpreting the numbers, you need to be wary of some of the limitations of them. Sure, they're very useful, very widely used and understood analytical tools. However, on their own, ratios don't tell you everything. And in particular, whilst they might identify some issues, perhaps relating to liquidity, that doesn't solve the problem, does it? You've got to be able to action the insights that you gain from ratios. So I think the key thing to remember is that whilst ratios are very useful, they're just part of the variety of indicators of how a business is performing. That's been a brief overview, therefore, of the limitations of ratio analysis.